Hello friends, welcome to another video. So we've completed till article number 20. If you have any questions, please post your questions in the relative videos comment section, and I'll try to answer all those questions. Today we'll be starting off with article number 21. Also, if you're new to the channel, please subscribe to my channel and please hit the bell icon so that you'll be getting the intimation of whenever a new video is being posted. Also, please share the video to maximum people so that we can reach to wider audience. Also, at the end of the session, if you like the content, please press the like button. So let's get started. Okay, article number 21, currency of payment. So article number 21 in a way can be force majeure in terms of currency. Okay, so what article says is, if because of some reason the currency of the guarantee is not available, or the currency in which the guarantee is issued, the guarantor is not able to make payment in that currency, guarantor can make payment in its native currency. Okay, so first of all, this rule will only apply in case the guarantee has been issued in a currency which is not the native currency of the guarantor, which means if beneficiary is in India, Bank Y, India, Bank X is in USA, applicant is in USA. Okay, since we are dealing with currency, so no need to mention specific location of the branch which issued the guarantee, because the currency is applicable to the entire country. So we have taken only we are considering only the countries in this example. Okay, now we received a request for guarantee issuance from the applicant who was there in USA. Applicant requested Bank X to issue a counter guarantee. Counter guarantee was issued for $1,000, and to the tune of this amount, guarantee was issued. Guarantee is issued in dollars to a beneficiary in India. India, the local currency is INR. Okay. Now, if because of some problem, okay, this Bank Y is not able to make payment in this currency, in what case it can happen? It can happen if this currency is not available in local market. Why that will happen? The regulator says you are not allowed to remit funds in foreign currency beyond a particular amount. Okay, so the regulator said that one bank cannot remit more than $100 in one shot. So this currency is not available. In that case, what URDG says is, Bank Y can make payment to beneficiary in INR, okay, which is the local currency of India. So if a claim is received under the guarantee, the claim will be paid in the currency of the guarantee. Now, if the guarantee is issued in any other currency other than the native currency of that region, then this article gives the option to the guarantor to make payment in the native currency. Similarly, if there is some impediment or there is some crisis because of which this currency itself is gone, then the guarantor will have the option to pay in its local currency. In this case, when conversion will happen, exchange rate will come into picture. So how exchange rate will be taken? Let's see that. Suppose demand is presented on 1st. Okay, this can be any month. I've just taken random calendar dates. Demand is presented on 1st. Now day 1 will be 4th, day 2, day 3, day 4, and on 8th, on or before 8th, payment has to be made to the beneficiary. Alright, now on whichever date the guarantor decides to make payment, that day's exchange rate will be taken. So suppose in these dates, on 4th the exchange rate between USD and INR was 71, 5th was 72, 6th was 70, 7th was 73, and 8th would be something. Guarantor decided to make payment on 6th. As per 70, guarantor paid beneficiary 70,000 INR. Beneficiary cannot tell the bank that why you did not use the exchange rate prevalent on the very on the previous day, which was 72. So in that case, beneficiary would have got $72,000. No, since the guarantor is making payment within the time period permissible, after checking the demand, the payment is being made within the time period permissible as per URDG. The guarantor will use the exchange rate prevalent on the day payment is made, and this is the date when the payment is due. Now another case, if by any chance guarantor is not able to make payment on this date, okay, and guarantor makes payment on say 12th. Now in this case, on 12th the exchange rate was 70. Then in this case, beneficiary can say that, boss, you have not made payment to me within the time period permissible as per URDG, so I want payment as per the rate prevalent on 7th, which is 73. So beneficiary can demand 73,000 rupees because the guarantor did not make payment during the time period permissible as per URDG. However, if on this particular date, which is 12th, the exchange rate would have been 74, then beneficiary would have happily accepted 74,000 rupees. Okay, so if because of some problem this currency is not available, guarantor can make payment in the local currency. The exchange rate will be decided by this criteria. If payment is being made when it is due as per URDG, then the date on which payment is being made, which is 6th, that day's exchange rate will be taken, and beneficiary will not be having any right to choose the exchange rate. Whereas if the guarantor missed to make payment within the permissible time period, and guarantor is making payment on some other date, then the beneficiary has a right to choose the exchange rate between this date or any other date when payment was due. So beneficiary cannot say that on 11th the exchange rate was 77, I want payment as per this exchange rate. No, the guarantor is making payment on 12th, so either beneficiary can choose the exchange rate prevalent on 12th or between these dates when the payment was due. Alright, okay, this particular scenario will also be applicable if it is illegal in the guarantor's country to deal in that currency. Now guarantor issued a guarantee for $1,000, paid 70,000 rupees because USD currency was not available in guarantor's country. Now URDG gives the option to the guarantor to demand payment from the counter guarantor either in USD or in the currency in which payment was made. Okay, why this option is there? When Bank Y registered the BG in its system, it registered the BG as a USD guarantee. Accordingly, the exchange rate would have applied, and Bank Y would have reported the guarantee amount in its books to the regulator. So Bank Y has registered the guarantee as USD in its books, whereas the payment was made in local currency. Now there can be a possibility that the notional rate at which this guarantee was converted and was booked or was registered in the books of guarantor, that notional rate was more than what payment was made to the beneficiary. So there is a loss which Bank Y will incur if Bank Y takes 70,000 from the counter guarantor. Suppose Bank Y, when it converted USD on that day's notional rate, the liability in Bank Y's books came out to be 72,000 whenever that BG was booked. If the guarantor demands payment from the counter guarantor in INR, then the guarantor is short by 2,000. So that is why URDG gives this option to the guarantor that either you can demand payment in this currency in which you booked the guarantee, or in the currency in which you made the payment. So Bank Y can either demand payment in USD or in rupees. Similarly, this similar structure will be applicable over here. So similar logic will apply in case of a counter guarantee. Bank Y made payment in euros to the beneficiary after receipt of complying demand. Bank Y lodged a claim under the counter guarantee for euro 1000. The counter guarantor is in USA, and because of some problem this currency is not available. So counter guarantor can make payment in equivalent USD. Same logic will apply regarding the exchange rate. If the payment is being made when it is due, that day's exchange rate will be applicable. If that deadline is being missed, then this entity will have a choice. Payment made in equivalent USD, but Bank X or the counter guarantor will have the option to demand payment in either USD or euros from the applicant. Okay. Also, this structure or this article will also apply or will also come into picture even if the guarantee stresses upon the fact that payment in any case will be made in the currency of the guarantee. So even if there is a clause which stresses upon or which restricts the currency of payment in the guarantee, still this clause will be coming into picture if there is some kind of an impediment beyond the control of the guarantor. Okay. Next is transmission of copies of complying demand. So beneficiary, when beneficiary would be claiming under the guarantee, beneficiary would be presenting demand which will be in paper form. So either it can be demand plus statement of breach plus any other document called for under the guarantee. When the guarantor has to send a copy of this complying demand to the counter guarantor, and then counter guarantor has to forward this to the applicant or instructing party. Now when this demand is received, Bank Y, the guarantor, will not wait for funds to be received from the counter guarantor and then will make the payment. No, Bank Y can make the payment, then send a copy of the documents to the counter guarantor. Similarly, counter guarantor will not wait for these documents to be received and then he will make the payment to the guarantor. What guarantor will do? Guarantor will check these documents. If they are complying, make payment to the beneficiary, then send these documents to the counter guarantor and lodge the claim under the counter guarantee. These two activities can happen simultaneously. Bank X cannot hold the payment till these documents are received. The moment these documents are received, Bank X will send these documents to the applicant. So this is article number 22, which deals with transmission of copies of complying demand. So we complete our training session over here. Hope it was useful for you. If you are new to the channel, please subscribe to my channel and please share the video to maximum number of participants. Have a great day. Thank you.